There are a number of different scenarios that can lead to a market crash. A combination of certain economic conditions leave markets primed for a crash. There have been countless market crashes in recent history, and each of these provide important lessons and learnings. It is important that investors are familiar with the factors that can cause a market to crash, how to measure and monitor them, and ultimately adjust their portfolio allocations in preparation for upcoming market conditions. Hey everyone, and welcome to another episode of the Aussie Investing Machine. In this episode, we'll take a look at the different ways that we can predict a market crash, or at the very least, anticipate when we think the market could be primed for crash conditions. Some market crashes can be forecast or anticipated. This is because they arise from certain economic conditions. There are other types of market crashes that don't occur because of economic conditions, and we'll touch on those as well. Make sure you stay tuned to the end of the video. I'll be giving you my take on the current economic conditions and what these might mean for the market in the near future. If you find the content in this episode informative and useful, maybe consider buying me a coffee. I'll leave my Buy Me a Coffee link in the description below. I'd really appreciate your support for the channel. As always guys, this video is for educational purposes only. Before making any financial investment decisions, make sure to go and see a qualified financial advisor. Let's kick things off by reviewing the different types of crash conditions. A panic-induced market crash is something we should all be familiar with, given that we had one earlier this year with the onset of the COVID-19 pandemic. This type of market crash has occurred a number of times in recent history, including in 2001 when we had the 9/11 terrorist attacks in New York. The fear and uncertainty triggered in the market by events like COVID-19 and 9/11 cause a domino selling effect for investments. This occurs as people lose confidence in the market and as a result in their investments. Even those investors who have been waiting for a market crash are not immune to the fear that is triggered by panic events in the market. You might be waiting to buy a great company at a very reasonable price at the bottom of a market crash, but panic-induced selling events cause even experienced investors to falter and not pull the trigger at the bottom of a market crash. It is only those with nerves of steel and those that have a positive long-term outlook that are able to buy in the dip of panic-induced market crashes. Of course, this comes with experience and seeing these types of market crashes before. I'm sure that there's many of you watching, including me, that wish they could go back to March this year and snap up some serious bargains. Okay, so on to the number 2 market crash condition, which is rampant speculation. Rampant speculation occurs when the price of stocks is driven way above the fair value. This usually happens due to unrealistic expectations regarding future growth and earnings. The greatest example of this type of crash was the tech bubble in the year 2000. As the internet was growing in popularity, the value of a lot of technology stocks went through the roof. Eventually, the market realized that the price people were paying for these technology companies was just way too high. At this point, the selling began. And again, we had a domino effect, and this continued for many, many months. To give you one example, the price of Microsoft in January of the year 2000 was $55. It did not reach and surpass this price again until August in 2016. So had you bought Microsoft at the peak of the tech bubble, you'd be waiting 16 whole years until you got your money back on your investment. Now that is a serious speculation-driven crash. Okay, so crash condition number 3 is low economic growth rates. Economic growth rates can be measured by looking at the GDP of a country. If there are sustained low growth rates of GDP, this can lead to a market crash. The likelihood of a market crash is even greater if you've got a combination of low GDP growth and also rampant speculation, which we just talked about. This means that there is a disconnect between the stock market and the economic reality. Does that sound familiar to you? This obviously does not end well and can cause a severe market crash. If we have a look at the United States and Australia and analyze their GDP growth over the last 10 to 20 years, we can see some interesting facts. The US GDP has maintained a strong upward path and is already at a record high. The Aussie GDP, on the other hand, is not doing as well. It hasn't even surpassed the highs that it reached in 2013 during the mining boom. In terms of GDP growth, the US growth has remained consistent but is trending down slightly. You can see that pretty clearly through this graph that's been produced by NBC. The Aussie GDP growth has similarly been trending down. We know for sure that the Australian GDP is heavily reliant on international migration. How do you think COVID will impact the Australian GDP given its impact on migration to the country? Leave a comment below, I'd love to know your thoughts. Okay, on to crash condition number 4, which is low interest rates. The housing bubble in the US that ended in 2007-2008 was the product of long-term low interest rates. This, in combination with very loose lending restrictions and a lack of a financial safety net in the banking system, led to major mortgage defaults across the country. As a result, many major banks went bankrupt and had to be bailed out by the US government. What we saw as a result of this was the global financial crisis, which caused prices of many assets to absolutely plummet. Australia, for the most part, was left unscathed due to quick government action using monetary and fiscal policy. Interest rates in Australia were slashed to encourage more borrowing, and government handouts reached record highs. At the same time, the Australian Stock Exchange essentially halved in value. However, the country did avoid recession. The value of the ASX would not reach the all-time highs reached at the peak before the GFC until November 2019. This is a whopping 11 years after the GFC. Currently, interest rates are at record lows, even lower than we saw before the GFC. Having interest rates so low is not ideal for reserve banks around the world. Dropping interest rates is one of the tools they use in order to stimulate the economy. And if interest rates are already near zero, they're running out of tools in the toolkit in order to generate economic growth. Another large economic crash at this point would be extremely hard for the Reserve Bank to combat. So that summarizes the 4 key conditions that I think could cause a stock market crash. So where does the market and the greater economy sit at the moment? Well, let's go through each of the conditions I discussed, and I'll give you my perspective on where I think the economy is at currently. So first, looking at panic. Is the economy currently in a state of panic? No, I'd argue it's not. In fact, it's probably the opposite. We're seeing a lot of vaccine news coming out, and we're seeing the first vaccines actually rolling out to the general public. This has actually caused a rise in investment in bricks and mortar stocks. Technology stocks, not so much, but your traditional value stocks and dividend stocks, yes, we're seeing big moves up. So no, I don't think we're in a panic situation at the moment. However, if there are any speed humps in the vaccine rollout, or perhaps the virus mutates and the vaccines are rendered useless, then yes, we could hit another panic situation due to COVID-19. So let's next talk about rampant speculation and the general value of stocks at the moment. One indicator we can use to measure the historical value of stocks is the Shiller PE ratio. The ratio is defined as the price of the stock divided by the average of 10 years of earnings, and it's also adjusted for inflation. When we look at the graph, we can see that the current PE ratio is certainly high compared to historical averages. However, it is important to note we're still not at the highs that we were at the peak of the tech bubble. If the ratio does appear to approach an all-time high, this could certainly be cause for concern. Many commentators and a lot of YouTubers would argue that the current ratio is far too high for investment in the stock market. Obviously, this PE ratio is a market average, so it won't apply for every share on the stock market. To account for this risk, many investors may choose to diversify their portfolio into different assets, such as gold, silver, Bitcoin, or even property. Before the tech bubble, we have seen speculation drive another market crash, and this was Black Tuesday in the US. This occurred at Shiller PE ratio levels lower than we are currently. Now, there were other economic factors involved, so I'd encourage you to read up on Black Tuesday to fully understand why the market crashed at that time. Next, let's look at low economic growth rates. We reviewed the current economic growth rates in Australia and the US a little bit earlier in the video. Whilst the US has emerged from the COVID slump quite strongly, this does not hold true for other major global economies such as Australia, Canada, and the UK. This is something investors should monitor closely, that is the GDP growth in these major economies. Again, any bumps in the COVID vaccine rollout may cause more disruption in some of these economies. If we don't see some of these economies spring back quickly and in the near future, I think this should be really one to watch for investors. Again, we're looking for that disconnect between economic growth and the value of stocks. If they get too far apart, obviously this is cause for concern. Okay, so finally, let's have a look at low interest rates. At the present, we're currently looking at some of the lowest interest rates on record. Now, this trend was in effect before COVID-19 hit, and it was only accelerated by COVID-19. For a number of years, we've seen slowing global economic growth rates. We know that bank lending rates are set by the central banks. At the moment, central banks are lowering those lending rates, so banks can give people money more cheaply, and therefore it is cheaper for people to borrow. The other action that reserve banks can take is printing money. The act of printing more and more money, in theory, should increase interest rates. Printing money is something that many reserve banks around the world are currently doing, especially the Federal Reserve and the RBA in Australia. We know that the intention of the central banks is to increase the interest rates as the economy recovers. If the money printing continues and there is no recovery in the economy, we may see a situation like we've seen in Japan over the past 20 years. As you can see, the Japanese GDP is lower than levels it reached in the mid-1990s. With these low interest rates, many people opt for more risky forms of investments rather than relying on bank deposits for earning interest. These riskier investments are either stock market or property investments. As a result, this additional investment in stocks or property could cause a bubble in the market. Now, we are currently in a very low interest rate market, so it's important to watch out for bubbles in stocks and property. This holds true especially if we don't see the GDP growth improve. To monitor this, we can look at the Schiller PE ratio to give us an indication on stock prices. And then you can also look at average market prices for houses compared to historical averages. In essence, low interest rates can fuel speculation. I think this is the one thing we should be very wary of in Australia. If you've got your money in stocks and property and we see a market crash or a bubble pop, you could be left looking very sorry. A strategy to protect against the bubble bursting would be to invest in assets that are trading near or under their intrinsic value. These types of investments can be very difficult to find in the current economic climate. So it pays to be very mindful of what you're investing in to have a good idea of its true value. And it is especially important to seek professional financial advice before making any serious investment decisions. I think a good way to look at what these safe haven investments might be is to look at the investing strategies of superannuation funds in Australia. Super funds are investing for people's retirement, and as a result, they tend to be quite conservative in their investment options. Looking at the build-up of a superannuation fund's investments could give you some ideas of what might be some conservative investments that could weather the storm of a market crash. Again, you can go back and have a look at what stocks performed well during the COVID-19 crash. I know certainly here in Australia, stores like Woolworths, which is listed on the Australian Stock Exchange, performed very well during COVID-19. This is because essentially they provide non-discretionary goods. People don't choose whether or not they want to buy toilet paper. They simply have to. As a result, their revenue stays strong even during poor economic conditions. As always, do your own research and seek financial advice before making any investment decisions. Well, that's all for this week. I hope you really enjoyed this episode. It was number 1 on the poll that I put out during the week. Thanks for voting. Make sure to vote in the future. It really helps me to know what videos you want to see. If you've identified any investments that represent really good value, make sure to drop a comment below. I'd love to know what they are and have a chat to you about them. Anyway, that's all from me for this week. Have a great week, and I'll see you in the next episode.